Hello, everyone, and welcome to our second Ask a Pro webinar brought to you live from Halifax, Nova Scotia, Canada, where I have the good fortune to be working with a bunch of biotech entrepreneurs in the Bio Innovation Challenge. Special thanks to BioNova for inviting me here to do this particular gig for the third year in a row. All right, we don't have a lot of time with Graham, so I am going to get right to it here. My name is Linda Plano, and I coach entrepreneurs on how to pitch and how to do good strategy. And as a result, I get to know a lot of really great people. We have the Mentor Smart program that is part of the MIT Enterprise Forum. I'd really love it if my mouse would show up here. Okay, good. Right, so MIT Enterprise Forum of Cambridge Mentor Smart program. I'm a co-founder and co-chair of that. We are right now in the middle of our launch for the fifth cohort. By all means, if you're interested at all in being a mentor or a mentee in the Boston area, please drop me a line and apply. We'd love, love, love to have you. And special thanks to Katya and Amy at the MIT Enterprise Forum office for all the help that they give. Okay, now about Graham Brooks. He is a very experienced investor. He is an engineer, but his license to code was revoked in 2008, according to his bio. So he has been doing investment in primarily data, health IT, digital video, and ad tech since 2007. But what I think you should really know about Graham is actually that he is he really gives back to the community. He is on the board of directors of the MIT Enterprise Forum. He mentors lots of people. He is a mentor for the Mentor Smart program. That's the caliber of quality we have for Mentor Smart. So without further ado, because we lose him right away at 2 o'clock, I am, well, 1 o'clock your time, 2 o'clock my time. I am going to switch over so that Graham can give you the presentation on how to get funded.
Great, can everyone hear me? Linda, can you hear me?
I can hear you. You're good.
Okay, great.
Everything's good in the back of my head.
Awesome. Well, thanks to everybody for the opportunity, especially thanks to Linda for pulling all this together. Mentor Smart is a great program that's been involved the last couple of years, and met some really great other mentors as well as some fantastic entrepreneurs that I'm still working with, even from the early years. So we have a lot to cover today. We're going to be focused on how to get funding, but we're going to cover both sort of all the different types of funding that you might get, as well as if you decide to go get institutional funding, what the process is like, and some tricks to how to get through that process. So I'm going to go fairly quick, but please interrupt with questions, and hopefully we'll get through it all. So as a CEO and founder, your #1 job is not to run out of money. You get to keep running your company until you run out of money. And there's many, many different ways to do that. And we're going to run through everything from bootstrapping, which is obviously a very risk-tolerant form of capital, all the way up to institutional investors and banks and all those sorts of things. And the type of financing that you go after really depends on the stage of the company, what your goals for the company are, as well as sort of the overall market and dynamics of the company that you're creating. So starting, imagine that a number of you sort of either in the past or currently are bootstrapping. And this is a really fantastic way to build a company. And I talk to a lot of entrepreneurs, and people look often at bootstrap companies as things that weren't able to raise capital. I actually think that often very successful companies are created bootstrapping all the way. And if you look at sort of being able to own 100% of something that sells for 10 or 20 million, that could be life-changing money for you as the entrepreneur. But you know, the equivalent of if you went and raised a whole bunch of venture money, you would have to sell for hundreds of millions of dollars, right? And so the risk of your ability to build something that sells for 20 million is much higher than it would be for trying to build sort of a multi-hundred-million-dollar company. So message here is that, you know, bootstrapping, everyone starts there. There's definitely a bunch of positives from control and ownership, and it's not a bad place. So if you have a company that you feel like you can get through on a bootstrap, it's definitely something to consider. That said, there definitely are some issues, right? It often, outside capital will enable you to grow faster, right? So you might be able to take advantage of an opportunity with outside capital. You could lose market share if you don't have enough capital. And you are sort of tied to your customers much more tightly as bootstrapping. And that can be both positive and negative. Often you see bootstrap companies get whiplashed a little bit by their larger companies, and they're never able to reach their end goal because they're constantly doing some consulting or something to get to the next revenue so that they can pay their employees. So again, definitely positive and negative. It also obviously is has some personal risks, right? So often bootstrapping, if you run a little bit short on cash, you don't take a salary, right? Which is hard. But one thing I wanted to again reinforce here is that a lot of entrepreneurs come to us and raise money, and they look at the process of raising money and the act of raising money as a real milestone, and it's not. It's a piece of the journey that you're on. And if you choose not to raise money, it really is a great opportunity. So often, as I mentioned, companies will decide to take some sort of form of outside capital. And if you look there at the bottom, there's a whole bunch of different types of outside capital that we will talk about today. But you really need to look and be very selective about the type of outside capital that you take, and make sure that you're getting outside capital that not just comes with money, but brings a lot of help in building a business. And a couple of outside capital, number one, is able to really speed up your time to market and your ability to deliver. Reduces the risk for you in terms of you're probably going to be able to take a salary ongoing. And the types of businesses that are best suited to outside capital are those that have either large capital requirements, which I guess with shared services and open source is less and less businesses today, or companies that are slow to revenue. So if you're building a new database technology or a new very, very in-depth technology that's going to take a long time, a large platform to build before you get to meaningful revenue, that's a great thing for outside capital. Closing market windows. So if you are addressing a problem at sort of a unique point in time, that outside capital will enable you to get in there and execute faster and win, similar to highly competitive opportunities. If you have sufficient capital to execute and your competitors don't, that's a true competitive advantage. And then obviously very large opportunities often require, so if you're going after a fundamentally industry-changing technology or a market, then outside capital really does help. But remember again that not all investors are created equal, and we'll hit that theme throughout the presentation. So we talked a little bit about how outside capital, I wanted to accelerate your growth. I wanted to show a little bit of data, but again, I think there's a selection bias with a lot of these firms that have larger opportunities taking outside capital. But in general, VC-backed firms are 6x the number of employees, VC-backed firms, and 5x the number of total sales. What this doesn't show, again, is the return to the original entrepreneurs, and those curves are going to be much closer together. Outside capital is great and does accelerate your growth, but it also changes the persona of what you're building. You have an idea that you've created, you've poured your life into it, and you are very excited about building that opportunity, and you want to balance sort of moving fast, but also not taking undue risk. Investors, on the other hand, the worst thing for us is a company that makes a couple $1 million, maybe it's profitable, but it's sort of, we call those sort of zombie companies, and they're the absolute worst. The best thing, obviously, is a huge home run that makes everyone a ton of money very quickly. And then, actually, we would much rather have you hit the wall at 100 miles an hour and fail than turn into one of these zombie companies. And so, again, that's where you want to sort of think through. And do you want to build a lifestyle business that spits off $1 million, $2 million a year, and you could get very financially wealthy, or are you really trying to build something that is going to really change the world and sort of take a swing for the home run. And so if you look here, I'm going to use this chart a bunch to sort of show where we are in the stage of the company, because often the stage of the company is what's going to help determine what type of capital to go after. And you see the money on the y-axis, the amount of money you raise is generally more and more and more. And the other thing is that if you look at time, one of the other things that's overlaid on top of that is the risk. So the risk of a company that you down over time. And that's very important because, you know, one of the lenses through which we're going to look at this is the risk that the investors that you're taking the money from are willing to take, and the risk that they really want sort of answered or beaten out of the business. So if you lay over top now, again, the different types of outside capital and how they fit into the various stages of growth, and we're going to dig into each one of these. We're going to start with the earliest, which is friends, family, founders, and there's actually a fourth F that I didn't put up here, which is fools. So this is often very, very risky capital. It's someone who is investing much more with their heart than necessarily their checkbook. So they're very, very risk tolerant. Often this is the first capital to come into the company, and you know, you might have no technology, no product, just an idea, right? And it's usually smaller amounts of capital, but just enough to get you going. There are some personal risks to this type of capital, obviously. It definitely makes Thanksgiving dinner hard, but as a venture investor, we love to see founders that have raised money from family members, because it definitely helps put more on the line for the founders, and you really see them. We want founders that are going to do whatever they can to make this company a success. We need them to walk through the walls. This is a newer slide, as you can tell. I haven't found the right graphics for it, but we wanted to touch a little bit on another form of very early capital. And there's sort of two sides to this. We're going to touch briefly on the crowdfunding, which is a relatively new form of capital. Again, very low sophistication, very high risk tolerance. And can be used when you just have an idea. You might not have figured out the technology. You definitely haven't figured out the marketing, the sales, and the rest of the business building. And it's a great form of capital, but I think it's a great form of capital for a narrow subsegment of companies, right? There's most Kickstarter projects are not successful, and it can be a black mark if you're not successful, right? I mean, I do a ton of diligence. If I find a non-successful Kickstarter, it makes me a little bit less interested, because it shows that you weren't able to effectively sell your product when you were trying. So again, it's all about trying to find the right source of investment given the stage and the type of company that you're building. Crowdfunding works best for product-oriented companies, so and consumer-oriented, consumer-focused companies. So if you're building a new remote control for a TV or something that's going to, it's a natural product that people are going to have to pay for, and it's designed out for the consumers, and it has a coolness factor to it, or things that people are going to be really excited about. Those often work well, and if you do a good video, you definitely can raise some great money here. And there's a whole bunch of positives. It's non-dilutive, meaning you're not giving up any equity. You could take this funding effectively and still own 100% of the business. It can actually be counted as revenue, right? So as you start tracking your revenue growth, and as later stage investors look at how much revenue you have, this is a form of funding that actually is more revenue than funding, which is fantastic. So that's crowdfunding. Definitely something to look into if you have that right company. Another way to fund the sort of very, very early technology building, right? So, and when I say technology building, what I'm really talking about is proving that you technically are able to do what you're trying to do, right? The invention behind your company. So another form of that is grants. And this is how a lot of research gets done. And there's a couple of grants in particular that are focused on commercialized resources for research, or research that's going into creating companies. And that's the SBIR grants for companies that are funded alone, and the STTR grants, which are companies that are being formed in conjunction with a university. These are moderately sophisticated investors, and make a new product, and that is readily commercializable. So some of the benefits here of the grant funding is it's non-dilutive, again, relatively easy to apply for, and it definitely helps validate your opportunity. So when we've looked at companies that have received these grants, they talk about the grants as they would any award, as validating piece. The big downside to them is that they're very, very slow, right? So you apply by a certain deadline. You have to wait 6 months to find out whether you got the grant, and then another 6 months before you get the first check. Now that said, over a 2-year period, you can get up to $2 million, which is a ton of money and can fund some, often fund some core research that then goes on to create some great companies. So definitely something that's worth looking into. Great. So now we're going to talk about sort of some of the more financially oriented capital sources. We're going to start with, again, the angels, which have the highest risk profile and are willing to invest at the earliest. Often, what they're looking for is the core technology to be done. So the funding sources we were talking about first were to fund that core technology creation. Angels look for that technology creation to be done. So you may have product building to do or engineering to do, but you have to show that you've been able to create your new technology, and now it's just a matter of creating the product around that technology. But that said, it's probably in data. You have limited to no revenue, so it's still very early on the market engagement side. And they're going to invest, $100K to actually now a couple $1 million. The angels are starting to seed financing, starting to take, put in more and more money. One of the things with this stage of financing you're seeing more and more of is the rise of seed funds, which are funds, professionally managed funds that invest just in this area, which are great. We've got a number of great seed funds in Boston, as well as a bunch of very large VC funds starting to do seed funding. And I'm going to take a quick tangent on that because I do think that that's a trend that can very much damage an entrepreneur. So as a venture investor, if I have a $200 million fund, for me to give you $200,000 is very easy to do, right? It's not going to affect the overall performance of my fund. Now, the reason that you don't want to take that money, even though you might be able to get it pretty quickly, is that it can make raising your next round incredibly difficult, right? So if you look at the risk that I would have to take to make that investment, I'm going to have to invest in 20 or 30 or 40 different startups to find the one or two that really are exciting into Series A. And so what you find is that a lot of those venture funds end up only investing in 7, 8, 9% of the seed investments that they make. And what happens is that there's a huge negative signaling effect when you go out to raise your next round. So if you raised from a venture firm who the only reason they gave you money was to sort of have a seat at the table, and if they're not leading your Series A, you're pretty much not going to get a Series A. Putting yourselves in our seats, right, as investors, we're looking at someone who has a sunk cost because they invested in you. They had a seat at the table. They had a right of first refusal, basically, and they're not exercising it. It is very hard to convince a partnership to follow on those circumstances. So if you're looking for that early stage funding, I would very much encourage you to go with angels. There's a bunch of really active angel groups in Boston, or seed finance funds. So seed focused funds, again, only do that one seed stage, and that's the primary portion of their investment. They're not investing just to get an option value on the company as it grows. So, and I have my email address and sort of handle here at the end. So if you have questions on any of this, I'm happy to respond to them. So after you've gotten your seed financing and you launched your product and had a couple sales, that's when you start looking at the venture capitalist. And there's many different stages of venture capital that you can raise, and we'll sort of go through those a little bit later. But the early stage, again, is very focused on probably having a product market fit. So demonstrating that you are delivering a product that the market was really excited about. You have a unique product that, as we like to say at 406, solves a bleeding head wound problem, right? So this is a problem that Someone absolutely has to get solved. They have the budget to solve it, and your product's the best product out there. So we want to see that, and that can be demonstrated with, revenue is a great way to do that. It can be just a couple customers, but there's other ways. Maybe you have a couple of very powerful partners that are starting to help you sell, or some other heavy validation of the product market fit again. The thing that we usually help companies with is establishing like a sales process, right? Sorry, I'm slide behind here. But the sales process, is what often the later stage funds look for, right? Seeing a little bit more scale, a little bit more revenue, a little bit less risk, a little bit more repeatable, predictable financials as you start raising larger and larger rounds to help scale the company. And those later stage companies are going to focus more on the operations and the large company building. And as you think about sort of valuations while you're building this, the key really is to set your valuation such that each subsequent round is an up round, and that is really important. Raising a down round or a subsequent round, so if you raise an A at 100 million pre-money valuation and you have to raise your B at a 50 million pre-money valuation, that's very, very difficult to do and can actually kill companies. And the reason there is that you have to go out to market and effectively say, we thought we were great. We raised our money to this plan, and we obviously didn't execute on that. Now, we still have something of value here, but we understand that we're going to have to take a haircut on the value that we thought we were going to create. And that introduces a lot of risk into the opportunity, and often those companies, because of the down round, aren't able to raise the following financing, end up running out of money and dying. So this is a chart that I love, which is how I think about the market, which is, again, the type of risk that the investors are willing to take, right? So the friends, families, and fools will invest in you. They really take the whole risk, except that usually they know you and are willing to bet on you as the founder. That grants and Kickstarters, those can be used to invest behind an idea and build a technology, right? Angels look for validated technology but are willing to take that product market fit risk, right? So when you raise your angel round, you want to go and prove that you have product market fit so that you can go raise your Series A. The Series A, as I mentioned, look for that product market fit, but take the sales risk. So often the companies that we see have a couple customers, 3, 4, 5 customers that they've what I call gorilla sold. So it's been their nephew's cousin who introduced them to someone else's company, and they were able to sell them, right? And when we invest, the first thing we do is leverage our network to help you sell your next 10 customers. And then what we do is work with you to figure out how to create a repeatable sales process. And that's what we try and do through the Series A, so that and when we go out to the Series B, we say, look, we know how to sell it. We have people in place to sell it. And what we need to do now is raise a whole bunch of money to scale that sales process. So that the risk that they take is, are you going to be able to actually scale that process, or is this a sales process that can only take so much risk or so much volume through it? Once you scale that sales process and at the end of the Series B, you're hopefully going to have very repeatable numbers so that you understand your customer acquisition costs, you understand your lifetime value, you understand each of your channels and your churn and your attrition rate through each of your channels. All those numbers backwards and forwards, and then you raise your Series C, and the risk there is, can the rest of the company scale to meet the sales demand? And then for the Series B plus rounds, those rounds are often in companies that are very likely to be very successful, and they're acceleration rounds. So they're for small acquisitions or to prepare the company for IPO or for a merger, something like that. One of the very important things here to highlight is the entrepreneurial risk declines once you get investors that have reserves for you, right? So what that means is if we do, I have a bridge over there on the right-hand side. If you have your goals in the Series B and you're a couple months shy of meeting those goals, but you're well on your way, and you don't want to have to go out and raise that down round because you didn't quite hit the goals for the round, if the investors have reserves, often what they'll do is they'll give you a bridge, which is a little bit more sort of an interim money to help you make it the next couple months, prove those things out, and then raise the subsequent round at a much higher valuation as the top round. So everyone knows that entrepreneurship is not a smooth up and to the right process. It's the roller coaster of lots of ups and lots of downs. And once you have an investor that has reserves set aside for you, they essentially saying they have a bucket of money to help you through those downs to bridge the next up when you can go raise. And that's the big difference between sort of the venture investors and the earlier stage investors. And the VCs that are doing that seed investing in the angel, that seed/angel round, they are not reserving for any of those companies. So that's the big difference there. So I'm going to take a quick pause and see if there's questions. That was sort of a whirlwind run through all the different types of financing that you can get, and then we're going to switch gears into a little bit more about what it takes to raise venture capital. And Linda, I can't see the questions, so if you want to tell me what they are, I'm happy to answer them.
Great. Hold on for just one sec, Graham. We have a question for you.
So my question is about the seed funds. Well, I have several questions, but let me start with the seed fund question. So it seems relatively easy to identify angel groups inside the cities and VCs. How do you find these seed funds?
Yeah, so outside cities, are you primarily focused on?
Sorry, could you repeat that?
So the seed funds are going to be found the same way that venture capital funds are found, right? It's through networking, and we'll run through some of this in the next section of the presentation. But networking, if you're working with a counsel or lawyers, they'll often be able to do introductions into the seed funds. They'll know all the people that are doing lots of deals in the geography. And again, if you get for one angel or one seed fund to contribute a portion of the round or commit to a portion of the round, they should help you find and connect with all the other funders that might be able to help fill out the rest of the round.
Okay, I have a follow-on question to that. So it seems, so I've spent a lot of time in Boston, and it seems most of the seed funds are focused on IT. Are there seed funds in Boston that are focused on life sciences?
You know what, that's not my space, so I don't have a good answer to that. I know that there are a bunch of angel groups that do a lot of life sciences, but I don't know about the seed funds.
Okay, thank you.
We'll take a look for that. Thanks.
So I'm going to jump into raising venture capital and the process there. And the one thing to remember is that this does take a long time, and the last thing you want to do, again, is run out of money while you're raising. It is a negotiation at the end, and if you require that a VC put in money to help bridge you to the end, they're going to lower the pre-money. They understand that they have the negotiating power. So make sure that you allocate a sufficient amount of time. Now, once you found the VC that you eventually end up doing the deal with, it's going to take between 1 and 4 months to do all the due diligence and all the legal work to get that done. So we tell all of our companies to allocate at least 6 months to fundraising. And there's an old adage: you're always fundraising. You should always be developing relationships with different funding sources. Often we like to talk to entrepreneurs very early in the process. There's an old adage that says when you're looking for money, ask for advice, and when you're looking for advice, ask for money. And that definitely rings true. So if you're very early, you should be establishing relationships. The worst part of my job is having to say no to entrepreneurs. So I love when someone comes in and says, look, we're very, very early on in the process, probably too early for you, but I want to tell you what we're up to and see if it might be a good fit down the line. It helps us establish a relationship. I learn what you as an entrepreneur are expecting to do, and it helps my investment thesis. If I see you in 6 months, you tell me what you're going to do, and then I see you 6 months later, and you've done all those things, that's an incredibly validating fact in your favor. And then the other thing is, if we feel that what you're doing is very exciting and you actually are ready for money, we'll tell you. We've gone to an entrepreneur that said that they weren't raising or was raising an angel round and said, no, you're actually ready for venture, and ended up doing a Series A. They stopped their angel round and we did a Series A immediately. So it's a good way. Again, you should always be establishing those relationships. Once you decide to actually go out and raise angel or venture capital, we'll run through a quick process here. But as I mentioned earlier, all VCs are not created equal, and you need to find the right VC. You also need to make sure you're ready. One of the issues that I see very, very often, probably one of the biggest mistakes of first-time entrepreneurs, is trying to raise money when they're not ready. It can be a very, very time-consuming process, right? I look at my job as an investor as taking as many first meetings as I can and as few second meetings as I can. So there's a huge drop-off, right? And if you are not ready or you haven't done your homework on the investor, you're wasting your time, and you're going to have to. Yeah, it can be very, very time-consuming. So make sure that you're ready. Make sure that you're credible. Make sure that you have the results. Make sure you've mitigated the risks that investor is looking for. Make sure that you're in the right verticals. You're in the right stage for that particular investor. It really results in revenue are the primary driver of all of this, right? So if you really have shown that you're able to do this, that's what gets investors excited. One of the other things that I tell entrepreneurs is that as you think about raising the money, one of the stories that we love to hear is someone come in and say, look, I'm not going to be raising for 6 months. Then they come back 2 months later and they say, look, I told you I was going to raise for 6 months, but I launched in the meantime and my servers are on fire right now because I've got so much customer demand. And so I have to raise money now because I need to take my server farm from, I need to get 100x the servers to just satisfy that demand. So it really is all about sort of showing in the concrete numbers. We've talked about this a bunch, but is this really a business that you should be raising venture capital for? I mean, you are going to be turning over a lot of control to the venture capitalists, not on a day-to-day tactical standpoint, but again, we are looking to invest in entrepreneurs that want to run 100 miles an hour at a wall and either go flat or break through it. We need to make sure that it's a large enough market that it's got great scalability, that you're addressing a real need. And that you're going to be able to make 10 to 30 times. You're going to sell for 10 to 30 times what we invest in at that first initial investment price. So work to try and answer all these questions in your mind first. So we talked a little bit about finding the right VC. Definitely do your homework. The number of venture capital firms has actually shrunk quite a bit, there's about 18 venture capital firms that are active in the Boston area in 2013. And you want to make sure that you're working with the ones that are the best fit for you. You want to, the only way to get a very competitive valuation and to create urgency in the process is to have multiple venture capitalists, excited about what you're doing. That said, I know that I'm going to be competing with a couple people for a really exciting new opportunity. I don't want to feel like you've talked to everyone in the space, because if I do, then there's a huge winner's curse, right? And I feel like the deal's been shopped, and if I decide to do it, I probably didn't see a risk that everyone else did, or I overpaid. So what you want to do is pick the 5 or 6 that you think are the best fit for what you're doing, most likely to say yes, and go to them and tell them, like, look, you are one of the very short list of people that we're talking to. These are the reasons we're talking to you. This is why we're a good fit for what you're up to. And then doing all the research, and we'll talk about this in a later slide, on the venture firm to make sure that it's the right fund for you once you get a little bit further down the process. VCs, as a VC, I sell the world's most commoditized product, which is money, and I actually sell very, very expensive money. So one of the other things is, as you move later and later stage in those early charts that I had, to later stage funding, the money that you're buying is more and more expensive. So the only reason that you would take money from an institutional investor is because they're going to bring a lot of other company building aspects to help you, right? Hopefully they have operational experience. They can really get in and add value. So at 406, 406 was founded by a bunch of partners that had been entrepreneurs before venture. So all of the investors at 406 have raised money, have sat in your shoes. And as we were looking around at our boards, what we found is that often it was the independent board members that were adding the most value. So these are the board members that didn't necessarily come from a venture firm, and they were adding the value because they often came out of the industry in which we've started our company. They had a huge network in that industry. They had sat in our shoes and had the scar tissue to help us through the tough decisions that they had made in the past and we were having to face again. And so we created 406, trying to institutionalize that knowledge and that opportunity and sort of enable venture funding to come with that same level. And I think that's really important. So make sure, again, that your venture investors know your space and are really going to be able to add a tremendous amount of value. You don't want them to just give you the money and then disappear. If so, you're way overpaying for the money that you're getting. So in terms of, back to the question of approaching VCs or angel investors, many different ways to do this. And we have funded someone that just sent us a business plan. I mean, you can do it on our website. But often what happens is we get a tremendous number of business plans submitted, and often what happens is those go to the bottom of the pile of companies I'm looking at because they're much less likely to be a very exciting company. So getting someone that knows us or meeting us through a process like this is a great way, right? So my goal is to meet as many entrepreneurs and look at as many different opportunities as possible. And there's lots of different ways to make a connection with a VC. And even, again, my email is at the end of this presentation. So if you guys have exciting opportunities, I would love to chat with you, right? And if I can't fund it, you're on you've got a new drug or something like that, which is, we don't do the pharma space. I can help you make connections to or suggest other venture funds that might be able to do that. So, it really is one of those other things. It's actually pretty easy to get in front of a VC if you spend the time and you do your research and you sort of execute a little bit. So the people that just throw in a business plan over the transom, it raises a little bit of a question about the entrepreneur, right, and why they're doing it that way versus trying to buckle down and meet some of these VCs. And I put our deal sources there. So if you look at our deal sources for Fund 2, over 70% of them were referred by other CEOs. So either a CEO we knew directly, or a CEO in our portfolio, or actually my last deal was referred by a CEO that we had passed on his opportunity. But I met him and I was talking to him and I said, look, here's an investment thesis that I'm looking for, and he grabbed me by the hand and so took me over and introduced me to another entrepreneur that he just met who was executing a company just in that space. So other CEOs, and the great thing about CEOs is they understand, what it's like to work with the various venture firms and can recommend the ones that are going to be the most value add and the best to work with. So in preparation for the first meeting with the venture firm, you often are introduced and you send some information to get the venture capitalist or angel investor up to speed. I don't read business plans. I've been in this business now for 8 years, and I've probably seen 2 of them. I see a ton of opportunities, and I don't have time to read a 40 or 50-page business plan. Now, that said, I encourage all entrepreneurs to put one together because it's an incredibly illustrative and helpful activity for you, but it's used internally. What I like to see is something that has a high skin value, that I can understand the opportunity very quickly and understand if it's a good fit for what we're looking for. So for me, the best thing is a PowerPoint, a short PowerPoint presentation, or even a YouTube video of your product, sort of a quick demo of the product. And the goal of that first initial connect is just to get the meeting. So you just need to get me excited enough about you, about the opportunity, about the market to say, and for me to realize that this is a great fit for my fund and some of the stuff that we're looking at to say, yes, I'm going to take that meeting. And that's a relatively low hurdle. The first meeting is the high hurdle, right? And so this is going to be a half-hour or hour-long meeting Try to do it in person if you can, but we take about half of our pitches and the first pitches over the phone using WebEx, so that works well. There's many different ways to do this. We have entrepreneurs that come in and just want to have a discussion, so no pitch deck. And we have entrepreneurs that sort of walk through a pitch deck and walk through a demo. And it really depends on what your style is and what works best for you. The goal here is to get us intrigued enough that we're going to take that second meeting, right, and where the real diligence starts. And so, I think one of the future slides, here's the pitch. These are the different aspects that we're going to be trying to understand. I encourage people to put the team up front, your bios, because the team is fundamentally the number one thing that we're investing in. We found again and again that if you invest in the right people, even if their initial idea is wrong, 85% of our companies end up being successful in an idea other than what they initially started. Maybe it's a small pivot, maybe it's a big pivot. But if you find the right entrepreneurs, they can navigate through that and are able to make a very successful company. So that for us is number one. So talk to us about why you're credible, why you're going to be able to walk through walls, why you are best suited to do this better than anyone else. Then tell us a little bit about the opportunity. What's the market that you're going after? What's the bleeding headroom problem that you're addressing? And how is your solution different than everyone else? Talk a little bit about the business model, how you're going to make money, what the price is. I also like to understand sort of the TAM, the tangible addressable market, which basically is defined as if you were to have 100% market share at your pricing level, and that market share was 100% of the people for whom your product is the absolute best product. How big a company would that be? Would it be a $500 million company, $1 billion company, $30 billion company? And how fast is that market growing? How many new customers are created every day? How much more are you going to be able to charge customers as they grow? Touch on competition. A quick thing on financials. I'm getting a little bit of an echo again. If someone can mute. Thanks. Financials is a dangerous one because it's the one area in the pitch that I, as a VC, probably have more experience than you. It's not an area that I think is tremendously valuable, but I need to see that you are thinking about them correctly. And really, there's a whole bunch of rule of thumbs that, again, Linda or someone that's experienced in this area can help you. But if you're trying to raise venture money needs to be 50 million in 5 years at least. It needs to be a $500 million market and growing at 20% a year at least. I want to see how you're sort of growing that and making sure that it's reasonable assumptions, making sure that you're aggressive enough that you're trying to build a really large company. Again, I don't want you to build a $5 million company. That's not interesting for me as a $200 million fund. So you want to make sure you have the right gross margins for a software company or a biotech company. So you want to have this in there, but it usually don't, and make sure that there's no red flags on it, but it's not necessarily a huge value add. And then a quick ask at the end. So how much money are you raising, and what are you raising it for? So the pitch, again, it's about sort of exciting and getting us really excited about what you're doing. When I start listening to an entrepreneur, I have to decide whether they go in the bucket of, I'm going to have to figure out how to convince the rest of my partnership to let me spend time doing diligence on this, and why this is going to be a great investment, or they go in the bucket of, I'm going to need to explain to this entrepreneur why this isn't a good fit for us, or why we're not going to do that investment. And so you're really just trying to get yourselves into that former bucket. We want to make sure that you're humble and coachable and people that we want to work with. We spend a lot of time with our entrepreneurs, and we don't, we have a no assholes rule, but we also want to have someone that has the confidence to be able to lead, right? So we want to be, have someone that we want to follow, but also someone we want to work with. Make sure to leave a lot of time for questions. Investors are not shy and will jump in with questions. Excuse me. Don't make a ton of assumptions in what you're doing. Another mistake I see with entrepreneurs is entrepreneurs will come in and say, oh, I was scheduled for an hour meeting and I had an hour and a half meeting, or I had it went way long. That can be a good sign, but it also can be a very bad sign. So I would plan, at least for that first meeting, to be sort of 30 minutes, and then if it goes a little bit longer for questions, that's great. But I wouldn't try and drag out the meeting because it really can annoy the venture investor. Great. So now, once you get through that sort of initial meeting at first pitch, then it goes into the due diligence. And this is going to be a very long process where we really try and validate everything, every aspect of the business. And it can be annoying, and you want to make sure that the venture investor is not getting you to do busy work. But if there is a reason, and you should be very transparent in asking your venture investor what the process is, and what you need to do and why they're asking for that, and all those sorts of things that are very valid and great questions. But you want to make sure that they understand your business incredibly well, because on our side, we will actually put together our own business plan for each investment that we make. And you need to make sure that we've done enough diligence so that our business plan matches your business plan. One of the worst things that can happen is a venture investor will make an investment and have one view of the company when the entrepreneur has a different view. That creates tremendous problems. One of the things that we'll talk about later, but it's harder to break out of an investment that you've made than it is a marriage. So you really need to make sure that you're both going in there with the same assumptions and that you're being very, very transparent with each other. So in the diligence, before the term sheet, which is where the vast majority of the diligence should happen, is there are going to be a bunch of talking, understanding your product, meeting your team. Diligence calls are going to be an incredibly important thing. So one of the first things that we do is with a company is we try to introduce them to 5 or 10 potential customers, and then we'll sit in on the pitches. When you talk to those customers, and then after you get off the phone, we'll call back the customer and sort of say, what do you think? Is this a product you would use? So it's helpful to you because you can get customers out of it, and often that's what happens. And it's also very helpful to us because it helps us understand how you sell and how much your product is needed by customers, and the budget process and all those sorts of things. So we do probably 5 to 10 diligence calls where we make the introduction, but then we also want to talk to customers, your customers that have used your product and can tell us who else they looked at, what their purchase process was, why they used the product, how the product is benefiting now, how they look at the ROI. Are they going to renew? All that whole side of things. And so those diligence calls are really a key portion of the diligence that we do. And it can be sort of weeks to a couple months to get all this set up and done and get through sort of understanding the technology and the IP and all those sorts of things. And you want to make sure that a venture investor does that all before they give you a term sheet. Because as soon as you get a term sheet and sign a term sheet, your options are limited. You no longer can sort of bid two guys off of each other, two venture funds off of each other. And so if they still have diligence to do that might tell them that they don't want to do the investment, if you sign a term sheet and then it eventually gets broken off, it makes it very hard to go back to the other firms that were interested in you and say, oh, remember the people that we said we were going with? They no longer want to do the deal. So you actually want to push the term sheet out until they've done all the diligence and are sort of at the 80 to 90% level of the investment. Then you're going to do a formal partner presentation. You're going to negotiate and sign the term sheet. And then there's going to be another month of work, and that's the legal diligence, which is it's doing all creating all the documents, the investment documents, and negotiating those, as well as really digging in and asking all the legal questions, making sure that you don't have a record, that you aren't building a product on on land that you don't own, that your customer contracts are tight. All really, if you've been good about sort of keeping all your documents in your house in order, that will go fairly smoothly, but it is a lot of work that absolutely needs to be done. We also do background checks on all of our investors, and often with the CEO, we'll run them through a full personality test. And the reason we do the personality test is to understand how best to communicate and work with that CEO. But the investment process definitely is intense. One other thought here real quick is that there's many different types of term sheets, and you hear about investors that are going to give you a one-page term sheet after a half-an-hour meeting. Again, if you sign that, you're limiting all your options. What you want is to make sure that they've done all the diligence before you get the term sheet, and you want as much of the terms in the term sheet. And the NVCA, which is the National Venture Capital Association, has a great term sheet that many investors use that's very detailed and will hash out all the key things. Because before you sign the term sheet, you guys have a lot of leverage to negotiate it. Once you sign the term sheet and you're negotiating the doc, the investor has much more leverage than you do. You should also be prepared for typical, for the deal terms that you're going to get. And again, this is more sort of for the Series A investment, but it's sort of 2 to 50% ownership. We're going to want to sit on the board and probably have a split number of seats, the same number of seats. The investors will have the same number of seats as the common shareholders, and then there might be an independent or two. Liquidation preference is common, which means that if the company sells for less money than we put in, we're going to get that money out, and sometimes we then participate as though we converted to common. There's going to be an option pool, which is going to be a chunk of shares set aside for future employees, and that's going to be taken out before we put our money in. So that's going to be diluting you, but not us. And then there's a whole bunch of rights that we have to say, the governance rights to say, oh, you can't go and raise additional money without us saying yes. You can't sell the company without us saying yes. You can't raise a ton of debt without the investors saying yes. And again, I would encourage everyone that's getting to this point to have a great, very experienced legal counsel. I would go with a big firm, one that does a lot of this. If you do, you want them to set your company up correct, and you want them to help you, guide you through this process, because otherwise things can get really screwed up, and it can really cost you in the future. So we're almost done here. I think we've talked a lot about this, but make sure you're finding the right investors. The most important thing on a term sheet is who signs it, both the firm and the partner. That's way more important than the valuation and the economic governance terms. And so all the diligence that we do on you, you should be doing on us. You should have to speak to our CEOs, make introductions. You should then do your own research to find CEOs that we didn't maybe talk about, or CEOs that are no longer with our portfolio, and talk to them about that process. We would like to work with information that we have. And again, the reserve, how they that reserve process. Not just reserving, a model down, make sure they have that. 100 other reasons why they were the opportunity that wasn't right for us. So don't get discouraged if the VC firms you are most excited about as it's not a good fit. Take their feedback, understand why they're acting, and try and make your pitch and your company better and stronger in the future. So last slide here is a little bit on 406. We're investing now out of our third fund. We'll over 600 might not have been 10 million under management, 7 investment professionals, and again, all of us came out of the operating side. And we're very focused on those 5 verticals up top. So if you have an awesome consumer-oriented company, or an awesome gaming company, or an awesome pharma company, we're not going to fund it. So, again, we probably be a waste of time to talk to, and shouldn't be on your short list. But, in the areas that we look at, we try and, make sure that we speak to every single opportunity that's out there. And, there's a bunch of, we've got 3 companies that are looking to go public in the next couple of years. So, yeah, it's been a great ride so far. So with that, a whole bunch of information. Hopefully it was helpful. I know a number of you are going to be super successful and very excited for you. And please reach out if I can do anything. And I have a couple minutes for questions if I can answer any.
Will an angel tell you that he or she has extra reserve funds to tell you upfront when you receive initial investment, or is this something not often spoken about?
Often angels look for investments where they don't have to have reserves. So they look to put in a couple $100,000 and either have that money take you to exit or take you to a point where you can raise lots of venture funding. Now, some of the angel groups are starting to get a little more sophisticated in thinking about reserves, so you can definitely ask it, but I'd say it's more the exception than the norm that they will set aside reserves for you.
Great, thank you. Questions? Yes, Ying.
I had a question about a comment you made about not raising a down round.
Yep.
Do you have any strategies? Because even if you're hitting your milestones, the next funder might not agree the valuation bump of that milestone or milestones. So how do you ensure that you're always going to have an up round?
Yeah, so that's a great question. So the way that I tell entrepreneurs to do it and the way I coach our portfolio is when you're raising your seed round and even your Series A and potentially your Series B, we're investing not in your metrics, but in the dream of what you're going to create, right? And that's incredibly hard to value. And often this is where entrepreneurs get ahead of their skis and end up raising at too high a valuation. So what I encourage entrepreneurs to do is think about the B, C, D round when you're going to be raising on actual financial metrics. Create that financial plan and think about what range your revenue can be at, and then look at your industry and look at the revenue multiples that your industry commands, and then sort of work backwards. If you're going to be doing, you're going to be raising your Series C at, and you're going to be at $30 million in revenue, and you have a 4x revenue, or let's say 10 million in revenue, a 4x multiple. That means you're going to be looking at raising your Series C at, in the 40s to 50s pre-money. And so then you want to subtract the amount of money you raised. So your Series B would have been, you say you raised $5 million there, so you would have to raise your B in the 20s to make it an up round, and then subtract out the next round and sort of work your way back into sort of the range that you want to be raising your round. And we focus much less on the pre-money and much more on the post-money, and making sure that the post-money leaves enough headroom so that, based on the revenue traction that we expect to get and leaving a little bit of, boundary in case things don't go 100% as planned, that we're going to continually be able to raise at the up round. Now, the thing that makes this really hard, especially now, is that it's a very hot market right now, and people are getting very aggressive valuations. So, a view at 406 is that that's going to blow up in the next, 6, 12, 18 months. And all of a sudden, you're going to have a whole bunch of people trying to raise down rounds, which is going to make it then throws the power into to the investor's hands. So you just need to think through all these things, and that's why I say that it's don't go after the best valuation. Find a great investor and find a fair valuation. One of the last rounds that we did was this an early stage round, Series A, where the entrepreneurial team figured out what they wanted the valuation to be, and it was probably definitely lower than they could have gotten. And then they went and they found that the two investors that they thought were going to add the most value. And I think they're going to be very glad that they did that way because it was a very fair valuation that they went with. But I think it's going to enable them to raise those continual up rounds, and hopefully that we as their investors are really adding a tremendous amount of value.
Okay, and can I approach an angel with a running prototype, or must the product, which is a web app, be ready for beta?
I think you could probably approach an angel with a running prototype, but the closer you can get to people that are actually using it, especially for sort of something like a web app, which is hopefully not overly technologically complex, the faster the process is going to go. So if you need the money now, maybe approach 1 or 2 angels and you can ask them, say, look, I'm not sure whether I should be raising yet. Would love your thoughts on where I am and how I fit with typical investments you look at.
All right, great. I know we've kept you a few minutes over, so I'm just going to let you go. Thank you so much, Graham. Thank you, Rob, for being on the call as well. Thanks to BioNova and the Bio Innovation Challenge semifinalists and everybody online. And thank you from me, Linda Plano, Plano and Simple. Have a great board meeting, Graham and Rob.
Thanks so much. Thanks, Linda. Bye.